Imagine for a second, like, you're sitting down to play chess against a world-renowned grandmaster.
Well, that sounds stressful.
Right. Like, normally you'd just be sitting there staring across the board, trying to guess what they're plotting, just trying to read their face.
Yeah, good luck with that.
Exactly, but what if, totally legally, someone just handed you their private handwritten notebook right before the match?
Yeah, oh, okay.
Yeah. Like, what if you could see exactly what moves they were planning, where they were shifting their pieces, and I guess most importantly, the actual underlying logic of why they were doing it?
I mean, that would be the ultimate cheat code.
It totally would. And that is exactly the mission for today's deep dive. We are peering directly over the shoulder of a billionaire investing legend.
We really are. We're dissecting the latest Q2 2026 Form 13F filing for Seth Klarman's Baupost Group.
Yeah.
So we're looking at a $5.41 billion portfolio here. And the goal is to uncover exactly how one of the strictest, most disciplined value investors of our time is, navigating a really complex modern market.
I can't wait. We are going to open up that notebook and just dissect these billions. But before we do, if you want to pull up these filings and play detective alongside us, we want to make sure you have the right toolkit.
Always important.
Yeah. So to access more advanced researches, follow Guru's latest movement, and leverage our latest Deep Values agents, welcome to download the Deep Values app from the App Store.
Mm-hmm.
And also, to track stock market temperature, welcome to download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
Awesome tools to have on hand.
Definitely. But a quick reality check for us and for you before we dive in. Disclaimer, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment or financial decisions.
Absolutely essential context there. I mean, blindly copying a billionaire's homework without, understanding the actual mechanics behind it.
It's a great way to lose money.
It really is. It's dangerous.
Right. Okay, toolkit assembled. Let's get into the mind of Seth Klarman. Because if you read his legendary book, Margin of Safety, you quickly realize his entire worldview is built on, well, absolute preservation.
Yeah, preservation is the perfect word for it.
Right. Like for him, risk isn't about a stock bouncing up and down every day. That's just volatility. Risk is the actual mathematical probability that you are going to permanently lose your capital.
Exactly. He completely refuses to play that daily guessing game, trying to beat the S&P 500 quarter by quarter.
Which is why his absolute return mandate often terrifies standard Wall Street fund managers, I imagine.
Oh, totally. Because when the market gets irrational, Klarman doesn't just ride the wave. He holds cash.
Lots of it.
Lots of cash. And he treats it not as a drag on his quarterly performance, which is how most managers see it.
Right, because cash isn't earning anything.
Exactly. But he sees it as a highly strategic call option on future market distress.
Ah, I like that. A call option on distress.
Yeah, so when the broader market has a panic attack and forces institutions to, liquidate assets at massive discounts, Klarman is just the guy standing there, completely unbothered.
Ready to buy $1 for 50 cents.
Exactly.
But I gotta say, the definition of $1 seems to have drastically evolved in his playbook recently.
It really has.
Because historically, strict value investing was about finding discarded, unloved businesses, right?
Yeah.
The classic Ben Graham cigar butts with just a little bit of equity left to extract.
Right, the stuff nobody else wants.
Yeah. But then I'm looking at the top of this latest 13F filing, and he put over 25% of his entire portfolio into just 2 mega cap tech stocks.
Yeah, that cut a lot of people off guard.
I mean, he expanded his Amazon stake by 20%. That makes it a massive $892 million position now.
Huge.
And he boosted Alphabet by over 16%.
Mm-hmm.
I am having a really, really hard time wrapping my head around this.
It seems contradictory, right?
Totally. Buying Amazon and Google is like paying top dollar for prime Manhattan real estate right in the middle of Times Square. How on earth does a strict, risk-averse value investor justify that as a value play?
Well, what's fascinating here is that it really comes down to a massive disconnect between standard accounting rules and economic reality.
Okay, how so?
So Wall Street algorithms, right?
Yeah.
They largely trade based on GAAP.
Generally accepted accounting principles.
Right. So under GAAP accounting, when Amazon or Google pours tens of billions of dollars into building proprietary AI infrastructure.
Like all those massive new server farms.
Exactly. When they build those, that spending is treated identically to replacing a broken office printer.
Wait, really? It's just treated as an expense?
Yes. It is logged as an immediate, massive expense that completely crushes their reported net income.
Ah, okay. So on paper, their price to earnings ratios look incredibly inflated because the earnings part of the equation is just being artificially depressed by all this capital spending.
Precisely. But Klarman isn't looking at the GAAP accounting penalties. He's looking at Warren Buffett's concept of owner earnings.
Owner earnings, meaning what exactly?
It means he looks at the cash the business actually generates and keeps. Klarman realizes that the capital expenditures for these AI data centers, they aren't standard maintenance costs. They aren't just required to keep the lights on.
Right, they're not just fixing the roof.
No, they are massive growth initiatives. I mean, Amazon Web Services and Google Cloud, they're essentially funding their own global expansion internally.
Okay, I think I see where this is going.
Yeah, they are building the new mission-critical utilities of the 21st century, and they're doing it from their own cash flow.
So the market algorithms are punishing the stock for all this heavy spending, but Klarman looks past that accounting noise and sees that they are actually just widening their competitive moat.
And it is an invincible digital moat. I mean, think about the switching costs here. Migrating a global corporation's entire data architecture off of AWS, that isn't like changing your cell phone carrier.
Oh no, it's a nightmare, I'm sure.
It's like trying to replace the concrete foundation of your house while you are still living inside it.
Oh man, what an analogy.
Right. It's an absolute logistical nightmare. So Klarman looks at that and sees a digital monopoly that is temporarily mispriced because the broader market just misunderstands its true free cash flow power.
Okay, that reframes it completely for me. So he is finding hidden value in companies with massive scale and essentially zero marginal cost expansion.
Exactly.
Are there other businesses in his portfolio that exploit that same kind of math, but, without having to build massive server farms?
Yes, actually.
Mm-hmm.
And that brings us to the traditional financial toll booths.
Toll booths, like Visa.
Visa is the absolute prime example here. It makes up 4.44% of his portfolio.
That's a pretty chunky position.
It is. And look at their business model. Visa operates with operating margins between 65 and 70%.
That is insane.
It requires almost zero maintenance capital. They don't build factories. They don't buy raw materials.
They just sit there processing data.
Exactly. Every time someone swipes a card anywhere in the world, Visa takes a microscopic fraction of a penny, and virtually all that falls straight to the bottom line.
Okay, but wait. I want to push back on the Visa thesis for a second.
Sure, go for it.
Because the standard argument I always hear is that Visa is a great inflation hedge.
Right.
Like as the price of a gallon of milk goes from $3 to $4, Visa's percentage cut automatically gets bigger, just naturally.
Yep.
But if inflation gets too high, things get too expensive, and people just simply buy fewer things, right? Doesn't a drop in overall transaction volume completely wipe out the benefit of those higher nominal prices?
It's a really valid concern. But historically, the math just doesn't play out that way for essential consumption.
Really? Why not?
Well, even if consumers delay buying, say, a new television, they still have to buy groceries, they still have to pay for gas, and purchase everyday necessities.
True. You can't just stop eating.
Exactly. So the baseline transaction volume remains incredibly sticky, while the nominal dollar amount of those transactions inflates. And Visa captures that nominal spread with literally zero additional cost to themselves.
Okay, so the volume is sticky because people still need the essentials. That makes sense.
Yeah.
But what about the other financial play he added? Because I saw Baupost initiated a brand new position in CME Group.
Yes.
Yeah, comprising just over 2.5% of the holdings. Now, CME is a financial exchange, right? Handling derivatives, interest rates, equities.
That's right.
I'm really stuck on this point, though. Wouldn't a financial exchange be incredibly vulnerable? Like, if the stock market crashes or interest rates spike unexpectedly, doesn't a financial company get completely hammered?
You would naturally think so, yeah. But it's actually the exact opposite.
Wait, really?
Yeah, that is the genius of this specific portfolio addition. CME Group actually functions as an uncorrelated hedge.
How?
Think about how a financial exchange generates its revenue. They charge a clearing fee for every single trade executed on their platform.
Right, they just take a tiny cut of the action.
So during periods of severe market distress, panic, extreme interest rate volatility, what do institutions and traders actually do?
I mean, they panic sell.
Right. They panic sell, they aggressively hedge their portfolios, they scramble to reposition billions of dollars.
Oh, I see. So they're trading significantly more.
Exactly. Trading and clearing volumes at CME actually explode during a crisis.
Wow.
The worse the macroeconomic environment gets, the more volatility there is and the more cash flow CME generates.
That's wild. So they thrive on chaos.
They really do. When a massive global bank needs to hedge a billion-dollar interest rate swing, They don't go to some startup app. They go to CME because CME essentially holds a monopoly on deep liquidity.
Yeah.
Traders are forced to go where the liquidity is deepest.
Okay, so by pairing Visa and CME, Klarman is essentially building a fortress here.
A fortress is exactly what it is.
Visa provides this structural shield against inflation, and CME provides a counter-cyclical shield against market panic and volatility.
Precisely. It's brilliantly balanced.
So we've got digital networks with AWS, and we've got financial networks with Visa and CME. Does this underlying network logic apply to physical goods in his portfolio?
Oh, definitely.
Because looking at the 13F, it takes a very sharp pivot into the gritty industrial supply chain sector.
It absolutely applies to the physical world. Baupost boosted its stake in Genuine Parts Company by nearly 90%.
90%.
Yeah, committing over $332 million. And they also hold massive stakes in Ferguson Enterprises, which does plumbing supplies, and Union Pacific.
I have to admit, on paper, these sound like the most boring businesses on the planet.
Oh, they are not sexy at all.
Right. Auto replacement parts, HVAC supplies, freight trains. But I assume the economic moats here are just as impenetrable as Amazon's, just built out of steel and concrete instead of code.
Yes, exactly. I mean, take Union Pacific. Their rail network across the western United States is an unassailable physical duopoly.
Yeah. Because you just can't build another one.
Right. You could have $1 trillion in cash today, and you still literally could not secure the land rights, the zoning, and the regulatory approval to build a competing railroad. It is physically impossible.
And rail is super efficient, too.
Way more efficient. It's about 4 times more fuel efficient than long-haul trucking.
Yeah.
Which gives them immense permanent pricing power.
Okay, the railroad I get. But what about Genuine Parts Company?
Ah, GPC.
Yeah, why increase the stake by 90% right now? I mean, auto parts don't have the same physical barrier to entry as a transcontinental railroad.
Right.
Anyone can open an auto parts store.
That's true. But their moat isn't just the physical parts. It is distribution density.
Distribution density.
Yeah. Genuine Parts has over 10,800 global locations.
Oh, wow, that's huge.
Right. So imagine you run a specialized manufacturing plant, okay? And a critical machine component suddenly breaks down.
Okay.
Your factory floor grinds to a halt. It's costing you $50,000 an hour in lost production.
Oh, at that point, you don't care if the replacement part costs $50 or $200.
Exactly.
You just care that someone can put it in your hands in 20 minutes.
That is the whole ballgame. Immediate availability is the only metric that matters then. And only a distributor with Genuine Parts' massive, dense global scale can guarantee that localized delivery time.
That makes total sense. They're the only ones who can solve the emergency fast enough.
Yep. But Klarman isn't just buying them for the distribution mode. He's buying them for a very specific corporate catalyst.
Oh, what kind of catalyst?
Genuine Parts is planning to split its automotive and industrial businesses into 2 separate publicly traded companies.
Hold on, let me stop you there. How does that math actually work out?
What do you mean?
Like, why does taking one business, splitting it in 2, suddenly make the underlying assets worth more? The business operations themselves haven't changed, right?
No, they haven't. But you are touching on a classic Wall Street inefficiency here. It's called the conglomerate discount.
Okay, the conglomerate discount.
Yeah. When a company has 2 very different divisions just mushed together, analysts struggle to value it cleanly.
So it's an appraisal problem.
Right. An investor who wants pure exposure to, say, automotive retail, they might avoid the stock completely because they don't want the industrial side dragging it down, and vice versa. As a result, the market applies a discount to the whole entity. By splitting them up, you allow specialized investors to buy exactly what they want, which historically causes the market to assign a higher valuation multiple to both of the new companies.
That is brilliant. So he is essentially manufacturing his own margin of safety.
He really is.
He buys a high-quality cash cow at a discount, knowing there's a built-in corporate event designed to unlock that trapped shareholder value. That is fascinating.
The textbook Klarman.
So, okay, finding these hidden monopolies is great, but true value investing also requires buying when the market is actively running away screaming, right?
Absolutely, the blood in the streets.
Yeah, and that brings us to the buying the dips section of the filing. Baupost holds massive positions in managed healthcare, like Elevance Health and Molina. But the position that genuinely shocked me was Norwegian Cruise Line Holdings.
Oh, yeah.
He increased his stake by nearly 113%.
It is a massive, high-conviction bet.
But how do we square that with the core philosophy? Like, we established, Klarman wrote the book on avoiding permanent loss of capital.
We did.
Norwegian Cruise Line took on a mountain of long-term debt just to survive the pandemic shutdowns. For a long time, they were essentially just floating debt obligations. How does a conservative investor justify backing a heavily indebted leisure company?
Well, this raises an important question, and this is where we have to look really closely at the mechanics of enterprise value and debt transfer. Let's break down this asymmetric turnaround thesis.
Okay, I'm ready.
First, you have to acknowledge the barrier to entry. Norwegian operates in a concentrated global oligopoly.
Right, there are only a few big players.
Yeah, you cannot just start a cruise line in your garage, right?
Hmm.
You need multi-billion-dollar shipyard contracts and half a decade of construction time.
Mm.
The physical supply of cruise ships is strictly capped by global shipyard capacity.
Okay, so the competitive moat is intact. They aren't going to get disrupted by a startup tomorrow. But what about that massive pile of debt?
The magic here is in the cash flow inflection. Norwegian's operating cash flows have decisively turned positive again.
Oh, really?
Yes, they're seeing record advanced ticket bookings, longer sailing times, significantly higher onboard spending.
People are revenge traveling.
Basically, yeah. And because they are finally generating massive amounts of free cash flow, they're using it to aggressively pay down that pandemic-era debt.
Okay.
And here is the core mathematical mechanism Klarman is exploiting. Enterprise value. It's roughly the value of the equity plus the debt.
Right.
So imagine a company has an enterprise value of $10 billion, okay, made up of $8 billion in debt and $2 billion in equity.
Okay, got the numbers.
If the overall enterprise value stays exactly flat at $10 billion, but the company uses its cash flow to pay down $1 billion of that debt.
Then the debt goes down to $7 billion, which means the equity mathematically has to increase to $3 billion to maintain the $10 billion total enterprise value.
Exactly.
Oh.
That $1 billion of value transfers straight from the debt holders into the pockets of the equity owners. It's a dollar-for-dollar wealth transfer.
That is incredible.
Klarman realizes that every single dollar Norwegian uses to deleverage its balance sheet is a dollar that accretes directly to the common stock. It's a deeply asymmetric bet.
Because the downside is protected by the structurally recovering cash flow.
Right.
And the upside equity returns are turbocharged by the rapid debt paydown. That completely changes the risk profile in my head. The debt isn't a terminal risk. It's literally the engine driving the equity return as it gets paid off.
That is exactly how Klarman sees it.
So I imagine the logic is somewhat similar for the healthcare plays. Elvins and Molina. Was he exploiting a specific mathematical panic there too?
Yes, but driven by a different, very temporary operational panic. During this period, the managed care industry was hit with what Wall Street calls medical loss ratio headwinds.
Okay, what does that actually mean in plain English? Medical loss ratio.
Essentially, during the pandemic, people delayed going to the doctor for routine checkups, elective surgeries, knee replacements, you name it.
Right, everyone just stayed home.
Exactly. So once the pandemic cleared, there was a sudden, massive backlog of patients rushing back into the healthcare system to finally get these delayed procedures done.
Ah. So the insurance companies suddenly had to pay out way more in medical claims than they historically forecasted.
You got it. This sudden transient spike in costs caused their profit margins to compress rapidly.
And the market freaked out.
Completely freaked out. The broader market panicked, dumping health insurance stocks aggressively. But Klarman looked at the actuarial data, and he recognized that a delayed knee surgery is a one-time catch-up cost.
Right, you don't get 2 knee replacements on the same knee.
No, you don't. It's not a permanent change in the business model.
Right.
He knew the cost spikes were completely temporary.
So he scooped up these incredibly durable, cash-generating healthcare franchises at deep, deep discounts while everyone else was running for the exit.
Exactly. He bought the temporary panic, which is exactly what Mr. Market does best, right? Overreacting to short-term fixable problems.
Totally. But, dealing with Mr. Market isn't just about knowing when to buy the panic. I'd argue the hardest part for most investors isn't buying the dip, it's figuring out what to do when you are actually winning.
Oh, the discipline of the sell.
Yes.
This is where the true Klarman philosophy really shows its teeth.
And he definitely showed his teeth this quarter. He slashed his stake in Wesco International by almost 54%.
Yep.
He reduced Eagle Materials by over 40%, and he completely exited a massive position in Willis Towers Watson.
He cleaned house.
He did. But he didn't sell Westo because the company was failing. He sold it after the stock had run up 47%.
Huge gains.
Right. I look at that and think, human psychology dictates that when a stock is up nearly 50% and everyone on Wall Street is cheering, you hold on and you ride the rocket.
Of course.
Why aggressively cut your winners like that?
Because human psychology is exactly what Klarman has trained himself to ignore for 40 years.
Wow.
The core discipline of value investing is ruthless objectivity. You do a rigorous mathematical appraisal of what the underlying business is intrinsically worth.
Right.
And when the market price eventually converges with your appraisal of that intrinsic value, you harvest the capital.
You don't get greedy.
You absolutely do not fall in love with the stock. You don't hold on, hoping a fairly valued company suddenly becomes wildly overvalued just because the chart looks good today.
You take the money off the table.
Yes. And you systematically reallocate it into an asset that currently offers a wider margin of safety.
And looking at the 13F, we can see exactly where some of that harvested capital went. He took those profits and bought a new position in Pershing Square Inc.
Bill Ackman's publicly traded holding company.
Yeah, but why buy a hedge fund holding company? Like, why wouldn't Klarman just look at what Ackman is holding and buy those underlying stocks himself, avoiding any of the management fees?
Because he is exploiting a very specific structural inefficiency here. It's called a closed-end fund discount.
Okay, how does that work?
Well, Pershing Square Inc. is structured in a way where it issues a fixed number of shares. And because of some complex market dynamics and institutional sentiment at the time, the price of Pershing Square's stock was trading at a double-digit discount to its actual net asset value.
Net asset value. So if you added up the market price of all the individual stocks Ackman owned inside the fund, it was worth, say, $100.
Yep.
But the market was letting you buy a share of the fund itself for, like, $85.
Precisely. By taking his profits from Wesco, a stock that had already reached its full fair valuation, and moving them into Pershing Square, Klarman is essentially buying a dollar's worth of high-quality, transparent assets for 85 cents.
Wow. He just reset his portfolio's margin of safety in one move.
It's elegant, isn't it?
It is incredibly illuminating to see it mapped out step by step like this. It really is like reading the Grandmaster's notebook.
Yeah, every single move is coldly calculated to limit the downside probability while maximizing long-term compounding.
So to synthesize this entire deep dive for you, the listener, Seth Klarman's latest filing proves that strict value investing has really evolved past just hunting for cheap cigar butts in the bargain bin.
It is a dynamic three-pillar strategy now.
Right. Pillar 1. Own the digital monopolies like Amazon and Alphabet because their massive artificial intelligence investments hide their true cash flow from basic accounting metrics.
Right, JAP versus owner earnings.
Exactly. Pillar 2. Exploit cyclical panics and misunderstandings in essential industries, whether that's buying an auto parts distributor right before a corporate split or buying a cruise line where every dollar of debt paid down transfers straight to equity value.
The asymmetric bets.
Yep. And pillar 3, have the absolute cold-blooded discipline to ruthlessly harvest your gains when the market finally agrees with your math and recycle that cash back into discounted assets.
If we connect all of this to the bigger picture, Klarman's framework requires absolute emotional detachment.
It really does.
You cannot let Mr. Market's daily mood swings dictate your portfolio. You just have to focus purely on the underlying cash flow mechanics of the business, not the blinking red and green lights on your brokerage screen.
And that leads me to a final provocative thought I want to leave you with today. It is a bit of a stress test for your own portfolio's margin of safety.
Oh, I like this.
Imagine that tomorrow morning, the global stock market announced it was closing for the next 5 years.
Total shutdown.
Total shutdown. You wouldn't be able to sell a single share, and you wouldn't even be able to check the daily price of your investments. Knowing that, knowing you were locked in, would you still sleep soundly at night owning the specific businesses that are currently in your portfolio?
That is the ultimate test. And if the answer is no, well, it might be time to borrow a page from Klarman's notebook and reevaluate your own margin of safety.
Keep digging, keep questioning those standard market narratives, and keep exploring the deep value hidden in the noise. Until next time, thanks for joining us on this deep dive.